Well, gold hit an all-time high again today as the dollar weakened and debt concerns are still on the rise. My next guest predicts that gold will go to $5,000 an ounce in the next 3 to 4 years. Robert McEwen is the founder of Gold Corp. He's presently the chairman and CEO of Minera Andes and U.S. Gold Corp. Rob is joining us now from our Toronto newsroom to talk about this prediction, which, you know, sounds a lot less crazy now than it would have a few years ago. Thanks a lot for joining us. First of all, I mean, the rise in gold prices that we've already seen, why do you think that momentum is going to continue, not just continue, but accelerate over the next several years?
A lot of people are looking at gold and asking just that question. They're seeing its performance relative to other currencies and to other investments and saying, why don't I have it in my portfolio? You're going to see an increasing demand for gold, and it's not a product that can be easily produced in large quantities. So it'll be a scarcity issue.
But it seems like what has fueled a lot of the gains in gold up until now has not been supply and demand. It's more been what some would say is speculation, hedging against the dollar, hedging against inflation. So if that's been what's fueling it up until now, why is supply and demand, why is that dynamic going to sort of take the forefront?
While it's been delivering good performance, Julie, it's absent from most portfolios. Most people don't have exposure to gold. And as everyone's watching the price of gold going up, some are starting to say, maybe I should own some. And they're right. And that's why the price is starting to move now into a range that everybody thought wasn't possible.
But doesn't that kind of set us up for an enormous risk of a fall? I mean, if everybody sees the upward momentum and they pile on, doesn't that then become even more speculative and less justified?
Ultimately, it'll reach a point where its purchasing power relative to other assets you'll want to shift out of gold into debt instruments or equity instruments or real estate. But at this point, we're far from that. Just survey a crowd in a restaurant any night and listen to their conversations. If they're all talking about gold, then you should be selling. If there's only 1 or 2 tables, you should think about buying.
Rob, you were just talking about sort of the popular view of gold, and you know, if a lot of people are talking about it, maybe it's a time to sell. I mean, sort of anecdotally, I have been hearing a lot of people talk about it, and you were talking about the dinner table indicator, if you will. A lot of people talk about the taxi driver indicator. If your cabbie says buy gold, it's time to get out. And you know, I have heard, again, anecdotally, folks talking about that. So, I mean, there is this argument that it's heated up too much already.
I think if you can think back, Julie, to the high-tech bubble and how many conversations about technology or real estate was occurring in, say, a cocktail party or a restaurant, I don't think we're at those levels yet. But we will get there one day. But I think that's several days off, or several years off from now.
I want to go back to the demand and supply issue that you were talking about. What is going to be fueling the demand for physical, actual gold primarily over the next several years?
It'll be the growth of the ETFs and individuals wanting to own physical gold rather than derivative products. You're looking at an expansion of 1 to 2% of the supply on an annual basis, and that pales against the expansion of the money supply around the world and derivative products. So you can artificially create money with derivative products, whereas you can't with gold. You have to take it out of the ground and produce it.
And yet,
that's the limiting factor.
And are most ETFs that track gold are backed up by physical gold?
They've been in the market buying, yes.
So if all of this is the case, I still have trouble seeing 5,000. I mean, how do you arrive at that number in particular?
A really simplistic way of looking at it, when gold ran the last time, 1966 to 1980, it went from $40 to just over $800. So let's call it 20-fold. If you take the low that occurred in 2001 of $250 per ounce and apply a factor of 20, you're up to $5,000. It's a very simplistic approach, but I think we're seeing a repeat of that cycle, only this time it's going much higher.
All right, we'll see
because
if you're
it's starting from a lower base.
Gotcha. We'll have to check back in with you, Rob. Thank you so much for bringing us your perspective here. Rob McEwen, obviously a longtime experience in the gold market. He's the chairman and CEO of Minera Andes and U.S. Gold Corp and was a founder of Gold Corp.